Hello, I'm Giuseppe Fazio,
I'm Jack Schmidtline.
and this is our investment portfolio pitch. Our client profile, his name is Trent Jones. The age is about 29 years old. His net worth's $5 million. His portfolio is $100,000. His risk level is highly moderate and aggressive. And his goals are Trent wants to take advantage of this unique market opportunity to grow his portfolio significantly and maximize returns over the next 12 to 18 months.
So our strategy overview, we have 5 of them. Our first one is going to be a bullish equity position. Second one's going to be a buy call option. The third one's a reverse iron condor complex option. The fourth one's a bearish equity position, and our fifth one is another long call option. So obviously, as you guys know, COVID-19 has been wreaking havoc on the markets over the past few weeks. Just to recap of the numbers, from March 4th to March 23rd, the Dow fell nearly 30%, S&P fell 27%, and then from March 23rd to April 8th, it went back up, or the Dow went up 20%, and the S&P went up pretty much 20% as well. So very volatile markets over the last few weeks. And then the short-term VIX, which measures volatility, saw a 250% change over that 2-week period. So markets are really kind of seen a lot of upswings and downswings over the past few weeks, and COVID-19 is, a direct result of that. So going into our first strategy, it's a strong bullish equity position on a company called ServiceNow. They're an enterprise software company, and they help advise companies around the world with technology and IT services. So our position would be to buy 91 shares at around $274.05, which is the market price as of April 8th. So that comes out to about 25% of our portfolio, or $25,000. And in the scenario analysis, a 10% gain in the stock price would give us around $2,500 profit, and then a 20% would give us around $5,000 in profit. And then same thing on the flip side, if it's a 10% loss, it would be $2,500 loss, and then 20% loss would be a $5,000 loss, roughly. So looking at the analysis, starting the fundamental, ServiceNow's market cap is $54 billion, so it's a large cap company. We like that because it means stable prices. We like the larger cap as opposed to mid or small cap, and it keeps it more stable. And then their business model is pretty unique, and they have a competitive advantage. They're relatively low cost to start up their model with. They have a flexible platform, so when companies use them, they can set it up relatively easily and be very efficient with it, which is something a lot of companies need, especially now in this climate. And then looking at their ratios, specifically their price to earnings ratio was greater than 80, which shows us that investors expect strong growth in the future. They had a very high stock price. As you can see here, it was around $360 before the crash. So a very high PE ratio, which is good to see. And then on top of that, their return on asset and return on equity ratios were 12.7 and 41% respectively. And that basically shows that they're making a profit on their resources, and that they're what they put into the company, they're also making a profit on, which is something investors we want to see. On top of that, they have an experienced management team across the field. They're very invested in their brand, and it shows us that they're in it for the long run, and they're going to help grow the company. From a technical standpoint, we see the graph here on the right. Basically, they were in a huge uptrend before this crash. As you can see, around January, the SMA 50 crossed over the SMA 200, which is a sign for a bullish future outlook. And that's exactly what happened. Their price jumped over that period before this crash in early February, or early March rather. And so we like the upward trend channel. And, I think we believe that this crash, especially with ServiceNow, was a little bit excessive. I think the coronavirus hit some markets and sectors especially hard, that it not necessarily overcorrected it. So we thought it's a great buying opportunity because it was in such a bull trend before, and we think that it's going to jump back up again. RSI is around 46, which is a little undervalued. Another thing we like to see, it's not overbought. And then a high average volume of trading around 3.5 million per day. So definitely makes sense with the trend of it going up. And then from an event-driven standpoint, obviously with COVID-19, they've had a great response. They've pretty much given access to their emergency response apps for government agencies and companies they work with to help make things faster and figure out where their employees are and who's sick, who's not. So a great kind of rapid response to that. And then there's also insider optimism that they're going to come out stronger than this. That's what the management team said. So those two things combined, along with, I think, their overcorrection of the stock price dropping down, I think is a great buy for a long-term position. Our second strategy would be a buy a long call option on a ETF called XLE Energy. The current price as of April 8th was $34.09. Strike price, we put at 30 for a break even at $36.60. So at total premium cost, we would buy 24 contracts at that premium for around $15,000, $15,840, which is 15% of our portfolio. Expiration date, it's a long term, so August 21st. Percent of profitability is 36%, and the IB rank is 48. So scenario analysis, if the stock goes up 10% or the ETF goes up 10%, it's around $2,000 gain. If it goes up 20%, it jumps to $10,000 gain. And again, it's infinite. There's no cap on the profit you can make. And then if it's a 10% loss, it would be an $8,000 loss. And if it's 20% loss, it would get capped at 15,840 because that's it would just expire worthless, and that's the max loss you can have. So basically, like I said, it's an ETF fund. It tracks the market cap weighted index of U.S. energy companies in the S&P 500. An overview of the oil and energy market. So oil has a direct correlation with energy, obviously. And so oil prices dropped significantly since this crash. They dropped 63% to $20.09 a gallon. And that was around March 20th, which is a huge drop from what it was around $60, as you see on the graph below. So what happens here is COVID-19 basically decreased demand drastically, and it still is decreasing demand because no one's using transportation, no one's flying. So the demand for oil is pretty much non-existent except for speculators buying it. And then on top of that, OPEC, which is a deal between Russia and Saudi Arabia to produce oil, they're producing oil at extreme rates without having places to store it. So you have an oversupply of oil and an extreme shortage of demand, which creates a price drop, a significant price drop. So basically what happened last week, there was political talks to cut production of oil, which they're going to do by 10%. But the problem is demand's still going to be dropping. So to recap this, basically oil is extremely volatile right now, but we think that in the long term, it's going to go back up since it was so low. Oil can't sustain these low prices because companies are going to go out of business that depend on oil prices to be higher. So that's why we think it's a good bet. You know, it's bullish with a long expiration, so it's a little more expensive with the premium, but we think that it's going to go up in the long run. So we think that we're going to make a lot of money on this call. And then our third strategy is the complex one, the reverse iron condor with a company called Blackrock. So the current price was $471.42 as of April 8th. Strike price again was $30. And what we would do here, we would sell a put at $460. We would buy a put at $467.50. Buy a call at $477.50, and then sell a call at $482.50. So what this means, boiled down, is to break even, we would need the price to either be less than $464.80 or greater than $480.20. So the total premium cost for this, we would buy 38 contracts at $2.70 for around $10,000, which is like 10% of our portfolio. Expiration date, April 24th, which is next week. Percent of profitability would be 88%, so very high, 37 IV rank. Our max profit is capped at 18,240. The max loss is capped at 10,260. So we like this. First of all, Blackrock is a company that provides investment management, risk management, and advisory services for retail companies worldwide. They're one of the biggest investment managers in the world with 7.4 trillion assets. They have an earnings report on April 16th, which is this week. Which is why we chose this option, because we think that it can be very volatile. With this current climate, we think that BlackRock can do very well, but at the same time, the earning report is bad because of what happened with coronavirus. It could also go very bad. So I like the option we picked because it basically gives us a window where the stock can go down or it can go up. It just can't sit in the middle of that price range, and we think that it's going to do that. As you can see on the chart here on the right, pretty big, since it's an expensive stock, the swings in prices are pretty substantial. So we don't think that it's going to stay in that price range, especially after this earnings call. And then we also have 7 days after the earnings call before it expires. So we think there's a lot of time for it to move either direction, which is why we think it's a great look. And it's also a hedge bet. So it's a limited profit, but there's also a limited risk.
Strategy 4 is our bearish equity position, and that's Boeing. The ticker's BA. It's in the airline industry. Our position is to buy 173 shares at $145, which takes about 25% of our portfolio. The scenario analysis is if it's up 10%, we're gaining about $2,400. If it's up 20%, we're gaining about $5,000. If it's down 10%, same thing, we're losing 2,400. If it's down 20%, we're losing 5,000. Now our analysis for Boeing. Boeing is a very, very prominent airline company. It's Boeing and Airbus, like the big two. So to lose a lot of business for Boeing is a big deal. So our technical, fundamental, and event-driven standpoints are, first off with technical, the support trend line looks really good. It's a possible upward movement, especially that COVID-19 is dying down somewhat. That lifts some hope up for them. The RSI is about 1.8, which is pretty low. The average volume per day is about $20 million, which is very much. Fundamental standpoint, the market cap's around $86 billion, which is very high, which also explains why it's so stable. Ratios, PE, ROA, and ROI are both pretty poor, standing around -1 point in management. Event-driven, coronavirus has taken a huge toll on airline companies. Boeing was trading around $350 before this pandemic, so I could see great potential that it will increase once this ends. Also, summer is near, so once COVID-19 comes to the end and everyone's able to leave their house, everyone's going to want to go on vacation, and they need an airline to do that. So I think that there's a great possibility that it could make some people money. And our fifth strategy for our client is Microsoft. It's a long call. The ticker is MSFT. The current price is $162.14. The strike price is $163.50. We find that that's where the maximum money is going to be. So if it's anything over, say, $164, it's really not such good of a buy. Market cap's $1,255 billion, which is extremely high. Portfolio is about 25,000, so 25% of our portfolio. Both the SMA 20 and SMA 200 are very positive and stay around 7%. The return on asset and return on equity are very strong. Return on asset is 15.80%, and the return on equity is 42.9%. Both are very high. And then our analysis for this. Microsoft is very strong and stable. Due to the coronavirus, it has taken a big hit, but they've bounced back. They dropped from under $140, and now they're standing above 160. So now that everyone is in quarantine and forced to work from their computers, this raises demand of Microsoft, causing everyone to use their products such as Microsoft Word, PowerPoint, Excel. So that's good for them. That also increases the possibility of a upward channel. So buying Microsoft at the current prices and letting it increase to about, say, $180 provides tremendous max profit for our client. It is risky because the POP is only 64%, but it's still more than likely, especially with Microsoft becoming more needed and reliable every day. So this provides Trent with a great buying opportunity. And then just to recap, our first strategy is a bullish equity position, about 25% of our investment. Strategy 2 is a buy long call option for XLE Energy, about $25,000 investment, which is also 25%. Strategy 3 is a reverse iron corridor for Blackrock, very specific, it's very specific to Trent's wants. Strategy 4 is the bearish equity position for Boeing, about 25% of our portfolio. And last but not least, strategy 5 is a long call from Microsoft, which is about 25% of our investment. So thank you very much, guys.